Hi, everyone. It is Wednesday, but it's an important Wednesday because it is 9/11. So I just want to take a second just to, give thanks to all those people that helped on that day, all those first responders and all the sad story of the innocent people that lost their lives. So just a moment just to kind of acknowledge that and give my best to all those that were caught off guard by that. What we're not going to do today is talk about the debate from last night at all. But what we're going to do is talk about something that is important that we see quite a bit about, tied into something fun, and try to cover a topic that is regarding critical thinking and very much misunderstood, or known but misunderstood, and that's the idea of causation and correlation. This is a very hard lesson statistically for an investment analyst to learn, and part of that is because the marvel of our brain is that we see patterns. It is an incredible attribute or characteristic that we have, that we can see these patterns. It's also our greatest enemy, because we'll see patterns that aren't there, or we'll make spurious correlations of things. And we have to differentiate between, say, a correlation, which in, say, portfolio theory is important. You want to see if there's a negative or positive correlation between something. In investments, it's a statistical measure to the degree to which two securities move about one another. So you want, does Apple track Boeing? These types of things, and you'll look at that data and work it out through the formula and see, is there any correlation? Is there a negative? Is there a positive? And that is very useful for portfolio management. Where it isn't as useful is when we go past simple examples. So, like, another very simple correlation would be, say, you're looking at going for a hike and you want to see, okay, is there any relationship between the elevation and the temperature? And you'd map out over the course of summers or many summers or this specific mountain, and you can see, yeah, there's a correlation between the elevation of the mountains and temperature. So those are useful correlations. But the problem becomes when we start making causations about that. And I want to jump into, because we're going to tie this into a very fun article we saw regarding Oasis. Now, for some people, this won't mean anything, but there's an Oasis reunion, and those people that like Oasis are just nutty. They go crazy. They're so excited. It was something that the band said they'd never do, but there is a correlation here with the stock market, and we'll get to that in a minute. But I thought this was really funny. And it's a good learning case scenario of seeing this article with present news, Oasis, oh my goodness, and this link between financial hardship. But first, let's take our first little step in regards to correlation and causality and look at a quick video from Freakonomics. I think it's quite an old video, but it'll give us a good starting point where we're going to discuss things.
When I think of bad historical assumptions about correlation and causality, I think of polio 100 years ago, when it was this horrible mystery that it was, claiming a lot of lives. And it was really scary because it mostly struck children. And there was a strong line of research that suggested that ice cream caused polio, that ice cream consumption caused polio.
Here comes Mr. Softy, the soft ice cream man. The creamiest soft ice cream you get from Mr. Softy.
The reason that correlation was thought to be causal was that polio spiked in the summertime for reasons that really weren't very well understood, but it did. And ice cream sales spiked during the summertime. So these researchers had seen that whenever there was a lot of ice cream being sold and consumed, there was a lot more polio. And so there was really literally the beginnings of this kind of ice cream persecution to try to stomp out polio. And it sounds ridiculous, but you see it all the time now, people trying to fight against or build up something that they're sure is connected to something else, which it turns out just isn't.
Okay, we'll stop there. And before we go into that, because that's someone might look and go, well, that's absolutely ridiculous. I mean, how could that possibly be that people would make that assumption? But this is how data is. And what we have today, though, to help us with that is we have algorithms, we have big data. And it used to be that you have analysts just run models and theories and scenarios to see if they could find these patterns. Now we can do it at rates that are incredible. But just kind of like with AI and generative, whatnot, AI, it's more important than just the data is what is the data actually telling us? Like, are these spurious? Are they ridiculous? Just because there seems to be a relationship for a short period of time or whatever period of time, is that caused because of it? And we see this in the news nonstop, and not because of maybe there's some misinformation purposely put out that they make these correlations, but also it's just kind of lazy. And people like to think that there's a cause for something to happen, and we'll see it all the time. Housing starts increased, which means that this went down. And no, we don't. There isn't exact evidence that that's the case. We could say that, well, it seems that the probabilities of this occurring, then maybe this. But people get used to hearing these things in the news, and they think, oh, when we're in a business cycle and this happens, then this happens. And if it was that simple, everyone would be making money and doing very well. But that's not the case. And this isn't to make people feel disillusioned by news headlines or people saying, oh, gold went up today because of this. You just read it and go, oh, maybe that probably had some impact. You could learn this very easy if you looked at hedge funds like I did years ago, say at Merrill Lynch, and you realize that someone's holding a position of XYZ stock. Some news comes out that's of no interest, or maybe it is some interest, but yet the stock drops. And people go, oh, it's because of this. Well, it could be a million different reasons. It could also just be that XYZ hedge fund has a short position elsewhere. They have to liquidate a winner, so they just did. Or that they had a time frame in their own head that they wanted to hold this stock, and then they just got rid of the position, moved along. You don't know, but if it's a big enough position, it can have an impact on the market. And that's very unsettling for people to think that all these factors in our market are coming to play whenever we can just say, oh, new housing starts mean this. Certainly economics has gotten better, and it's not only economics that this happens, this correlation effect happens in everything, happens in science all the time. But let's just jump into some funny ones here before we get into Oasis to give people a bit of an idea of where this can take us. So there's a great website here. It's called TylerVigen.com, Spurious Correlations. So we'll scroll down through a couple of these, and I'll just kind of, say them here, like annual U.S. household spending on pork and the Lululemon stock price. Well, look at that. So if you're looking at it as just data, you'd go, okay, I just have to go track how much pork is being eaten, and then I can either short or buy Lululemon stock. I'm going to skip down to some really funny ones. The number of movies Will Smith has appeared in correlates with electricity generation in Kosovo. Now, there is some divergence here as well in this graph, but you can see there is some correlation. And now, once again, this sounds ridiculous, but the graph and the data is showing us otherwise. UFO sightings in Utah and patents granted in the U.S. Some people, you could come up with all sorts of reasons as to why this is occurring, but it's nonsensical. And just scrolling through a couple more, I'm going to just go to say the distance between Uranus and the sun correlates with the global count of operating nuclear power plants. That might start going off since we're getting a lot more nuclear power plants coming online. But anyways, you get the drift. There's a huge difference between this idea of something correlating and then it being caused by this. And this is where people get tripped up all the time. And this is where, I can tie back to the debates. We hear people making arguments about things like, I could say albinos built America. You go, well, that's not necessarily true. I could probably find one albino that did help build a railway or something, or a mine in America. And then you could logically say, yes, they did help build. Now, it's such a fraction of a number that's statistically inconsequential, but you can make that claim. You can state that. And we see this in news all of the time. Of this wild out there thing, but no, there is an association. So I can make that claim. I can say that this did this. And people do this disingenuously all the time. It's been ramping up, especially, since the mid 2000s, whenever the US controversially allowed propaganda to be used against their own citizens. We see that in Canada as well. And part of that too. I mean, that's a whole other conversation. But people need to control the dialogue. And as we've got social media, we've got ability to research for ourselves. That control of dialogue has become very, very difficult. And then we get into the whole realm of misinformation and a fight between how much money do you have to promote an idea and global acceptance of that idea. And it also, unfortunately, leaks into, things like you see Taylor Swift is backing this politician. I mean, this is actually a news headline I saw on Bloomberg. I mean, this is so irrelevant. And I'm shocked that this has become news. It's saddening when you look at the state that we're in, that some entertainer, pop singer, their views on politics will actually genuinely affect some people. And that's a poor state of where we're at. And why does that matter? Once again, when it comes to markets, well, markets are made up of people. And that control of the message does matter. So let's kind of jump into a Harvard Business Review thing, which talks just about this. And this was back in 2021 by Michael Luca. Leaders, stop confusing correlation with causation. And it's a great little article. It's not long. I would urge people to go read it. We won't go through too much of it, but it'll look at things like the Washington Post in 2020 said, a review of spending on state and local police over the past 60 years shows no correlation nationally between spending and crime rate. Now, of course, you'd know that is absurd, just intuitively. And you go, well, how could it possibly be that the data shows that? And it goes, well, that correlation is misleading. So this is once again a misleading or misinformation, either purposefully or just the writer had no idea. An important driver of police spending is the current level of crime, which creates a chicken and egg scenario. So causal research has in fact shown that more police lead to reduction in crime. So it's the exact opposite. And you can see how that interpretation or the asking of the right questions becomes critical when you're analyzing any statement. When if it's just devoid of just the sheer data, asking the questions is very important, and that ties into the whole generative AI, chat bots, chat GTP. The way you ask the question is going to matter. How you interact with these tools that we have, and also realizing that these tools have been given certain data to make it biased. And we've seen that with Gemini. We've seen that with ChatGPT. I mean, I won't even bother getting into those. You can research those and look into those on your own time. I would say they're funny, except that they're so nefarious and harmful. And that's part of a further conversation that people will have to have in regards to data. And then, this all ties into where we are today with so much chaos, so much going on, so many narratives conflicting and promoted. It's hard to get through what is real and what's not real, and then also to remove our own bias, because we're going to want to see these patterns. We're hardline for it, and then if we have a belief that we feel like we want to defend, then it comes in even harder. I mean, I bang my head against the wall continuously because it sounds like we're doing this energy transition. It seems like we're going ahead, yet they're not funding mining, acknowledging that this needs to be done. That is no end to the frustration. And I ask, and luckily I get to interview a lot of CEOs and presidents, and I ask them all, whether in the interview or after the interview, and they all reflect on the same thing, is that this frustration as to, well, we don't know where they think they're going to get this material. We don't know why they're not funding it. We don't know why major pension funds in Canada or the major amounts of money aren't flowing in to try to harness these materials so we can actually do this transition. And then on top of that, because we're in this very small space in mining, we see each other at events, and it's a very small community. Most of the people that are probably watching me have some background in mining as well, and have followed me for some degree. And we're trying to reach out to new people, but it's tough. It's tough because their imprint of what mining is and what they're told in school, what they've been told, say, from the Canadian government, is the exact opposite of what's needed and what's required. And that's a lot of effort to be able to change that narrative over. And when we're over on this side and looking at certain news flow and looking, say, at debt levels and go, well, how come, say, even at the debate yesterday, no one wants to talk about this debt crisis, this debt level. And that's a concern we see on our side of kind of alternative news. If you're looking at like Stansberry Research, or if you're looking at Kitco, the debt is always a discussion. And part because it's true. There's like enormous debt. And one shakes their head and goes, how come no one wants to talk about this? And why is this not an issue? Well, we'll just jump into this very quickly and take a look at JP Morgan. I'll send you the link as well if you send me an email. We get a newsletter from them all the time. So what risks do high debt levels and wide deficits really pose? So they look at this article here, and it goes over all of the debt, saying the S&P Global downgraded the debt in 2011. We see the projection of the budget suggests $2 trillion deficit this year, the ratio over 120% by 2034. Highest debt levels will increase borrowing costs. We see the borrowing costs going up. And this is an interesting read to kind of go through. I won't bother going over every step of this, but let's just kind of go down to where they kind of let us know that this isn't a risk that they're concerned about. They don't believe that this is something we need to really worry about. Deficits remain wide and debt levels continue to rise. Part of the problem is that any type of reform would be like raising taxes would be onerous, and they want to, and often printing of money helps to increase growth and could increase productivity gains, and we see that with AIs and tools and whatnot. But that they don't believe that there's any reason why in the U.S. it's an issue, and the long and short of it is because they own the printing press. And when they talk about this, they say it's not an issue for the U.S. because they can print more. They can. It becomes an ownership for other companies because they're based off the U.S. dollar. But for the U.S., it isn't. It really isn't an issue. And they see it a bit of a lost leader. Now, they do hearken and do kind of highlight a little bit about this BRICS issue. And they say, well, there is an implication if the BRICS association becomes more significant and becomes a threat, a true threat. I think that they don't necessarily feel that it is a true threat. There is, of course, lots of conversation. It's something that's covered on this side of the conversations, not mainstream, more than it is anywhere else. And once again, I think because generally the big investment banks don't feel that the US dollar won't ever be the main go-to. And that even if there is a challenger in the BRICS, how strong will it be? And I think there's a lot of fairness to that. I mean, even if they announce in October that we're doing a new currency, we're coming off the system, or in part, they can't just fully come off. They just won't. The amount of trade they do is enormous. But even if it was 10%, which would be enormous, what does that actually look like? And yes, the article mentions as well, you should be looking at gold, which we like to talk about, gold and silver. These are things that you should be. But as far as the debt itself, they just don't find that it's a narrative that really is worth pursuing. So, I mean, I'd love to see your thoughts. Now, a lot of people will fight against that narrative because we're over on one side looking at data and saying, how could this not be an effect? How could this not matter? And I think it's a matter of perspective on a couple things. One, we have to bear in mind the BRICS, that entire concept, that association was designed by Goldman Sachs. So that's an interesting enough discussion all in itself that people forget that it was, I think it was back in 2001 was when it was first pitched. It's been worked on at Goldman Sachs for quite some time. So one could argue, well, wait a second, Goldman Sachs is spearheading and developing an association that will be literally against its own country. That's an interesting conversation to have. And that being said, as well as these groupings of countries, if they have a payment system, which they will agree to, what can that really look like? Because these aren't necessarily friendly nations. I mean, some of them kind of get along, some of them don't. It's very loosey-goosey. So something to think about. I'd love to hear your feedback because they're controversial. They're important. I think regardless of those, is the acknowledgement by JP Morgan of reflecting on precious metals is key. It's very interesting. It's very good that they would even bother to mention that in this article is good for us on this side of the aisle, looking at strong foundations of strong money and whatnot. Once again, love to hear your feedback. We've covered a bunch of different things. Oh my goodness. I almost forgot. I didn't even talk about the Oasis thing. Oh my goodness. So we'll wrap up in conclusion with the funny, peculiar relationship between Oasis and market volatility. Now, this is done by Joe Sullivan Bennett. Sorry, I almost forgot about the whole funny Oasis one. So formation of Oasis was in the early 1990s. This was a period of high inflation, lots of monetary price changes, oil price shocks. There was the invasion of Iraq and Kuwait, and a big downturn in the economy. And we had Liam and Noel Gallagher, along with the band, founded the legendary group back then. And in this article, he hints at this parallel between Oasis and this turbulent economic environment. The second major point was the release of Definitely Maybe and the Great Bond Massacre of 1994. So they released, the band Oasis released their album in 1994, and it was the fastest selling debut album in UK history. Huge. Now, this also coincided with the Great Bond Massacre, in which about $1 trillion was lost off a huge market sell-off due to rising interest rates, massive volatility. And the author likes to suggest that Oasis music like Live Forever captivated audiences, and while the broader financial market was experiencing severe upheavals. We then jump forward to the breakup of Oasis and the global financial crisis back in 2008, 2009. So in 2009, Oasis disbanded. The brothers hate each other. So they have, and it's not just like a gimmick. They are notoriously ill-willed towards each other. So the timing of their breakup, the markets began to recover, once again coinciding with a period of financial turbulence, solidifying the band's association with extreme market volatility. The author highlights the irony of the breakup aligning with this pivotal moment in financial history. And what's to say about today? Well, the Oasis reunion has been announced. On August 27th, 2024, Oasis announced a reunion tour almost 30 years after this debut album and 15 years after the breakup. What could this mean to the market? This is maybe the most important question. Anyways, so that's a great fun article that shows correlation. So what's it? Maybe it's telling us we're in for trouble. Like that this is the big sign. But anyways, a bit of a laugh. I hope you enjoyed that. If you like Oasis, hang on, because maybe there are troubled times ahead. Anyways, everyone, it's great to have this kind of chat with you on a challenging Memorial Day here. But I hope that we brought a few laughs and also a bit of a highlight of a key critical thinking term regarding correlation and causation, and gives people a little of a head scratch. Anyways, love all your comments. Feel free to keep sending them on. We enjoy them, and we look forward to talking about a new topic on Friday.